Hello class, and welcome to this lecture on aggregate expenditures in our course on macroeconomics. To give you a roadmap of what we're going to discuss in this lecture, we're first going to define what aggregate expenditures are. We're going to talk about the differences between aggregate expenditures and gross domestic product or GDP. We'll then derive the actual model and graph aggregate expenditures in the context of its relationship with GDP. We'll talk about the determinants of the components of aggregate expenditures, particularly consumption, investment, and net exports. We'll also talk about the marginal propensity to consume, which is pretty important for deriving what's known as the multiplier effect. And then we'll finish the lecture by using aggregate expenditures to derive the aggregate demand curve, which will be very useful when we talk about aggregate demand and aggregate supply, and also when we basically talk about policy for the remainder of the course beyond that point. So what is aggregate expenditures? So now what we're transitioning to is basically assessing the size of the economy, not in terms of GDP where we would basically just calculate numbers from data that's collected, but right now we're talking about a concept, and this concept is basically the total spending in the economy. And this will help us understand whether or not the economy is in good shape, bad shape, because that's really where we're headed. We're trying to figure out what kind of status does our economy have? Are we in a good situation or are we in a bad situation? Because we can talk about relative change, but are we where we should be for the long term? Is $20 trillion enough or a lot in terms of dollars, in terms of productivity? This can kind of help us understand whether or not that is the case. So aggregate expenditures is just the total spending in the economy, and it has four components. The components are consumption, planned investment, government spending, and net exports. Now, that should seem familiar because of the fact that they look an awful lot like the components in gross domestic product. But there's a slight difference there. The slight difference is that planned investment is a component in aggregate expenditures, but actual investment is the actual component that's registered in real GDP. So that's where the potential difference can occur. For right now, we have essentially assuming that they are the same thing, and typically they will be the same thing. I have a little aside there about the classical model. So if you ever derive aggregate expenditures in a classical versus Keynesian, they just use consumption and investment because they think government spending doesn't really have an effect. And then usually the classical model is a closed economy, so it's not including net exports. Well, for our class, we're going to be including all of it. But long story short, aggregate expenditures is just the total spending in the economy. So there's a slight difference between spending and actual production. Because remember, GDP, it's so important to remember this distinction that GDP actually measures production and not actual spending. So what is planned investment? Planned investment is the investment spending that businesses intend to undertake during a given period. So while that seems pretty obvious, there's a time lag that's going on here. So planned investment is a firm deciding, you know what, we've produced this much, we have this much in inventory, we think that we're going to make this much in the next period of time. And so planned investment turns into actual investment when the stuff gets produced. So actual investment is reflecting the value of stuff that is being produced in the economy. Planned investment is the spending that's being done to make the production happen. So that can change, that can differ because there's a time lag. It's like, I decide I'm going to make something. Well, that won't be reflected in GDP until it's actually made. That's why we don't count intermediate goods, we only count the value of final goods. So where does that kind of fall in the realm of what we've talked about in terms of GDP? That's going to fall under inventory investment. So there were three components of investment. There was business fixed investment, there was residential investment, and then we have inventory investment. So inventory investment is goods that are produced but not yet sold, and that is where the differences in planned investment and actual investment could occur. Now, if they're not, there is no difference between planned investment and actual investment. If the company or the economy has been producing consistently the same amount of production month over month, year over year, then there isn't going to be a difference. They're going to keep producing the same that they were producing before. And then we actually have what's known as a macroeconomic equilibrium because we're balanced out. The amount we're producing is the same, so the flow is going to be consistent. So GDP will reflect that consistent flow. But if there's a change in our inventories, whether it's because we sold more than anticipated or we sold less than anticipated, then that will reflect a fluctuation and a disconnect between what's actually being spent for the next phase of production and the actual amount of production that exists in the economy in that moment in time. So if that isn't the case, then we have macroequilibrium. But now we're going to talk about what happens when that is the case. So if they aren't equal, then that means that there was some unexpected change. Now, if there's an unplanned decrease in inventories, that's actually a good thing, because an unplanned decrease in inventories implies that we're selling more than we anticipated. So typically when we're so the example that they might give you is like refrigerators. So you're a refrigerator manufacturer and you produce 300 fridges a month. You anticipate to sell 150 a month, so usually at the end of the month you should have 150 fridges left in inventory, so you produce another 150 every month. The problem is what happens if you sell 200 or you sell 250? Well, then you only have 100 in inventory, you only have 50 in inventory. So to replenish your inventory to the level that you're expecting it to be at, 150 units a month, you have to make an extra 50 to 100 units. Well, in order to make an extra 50 to 100 units, you have to spend more money. You have to produce more, so you have to spend more. So that is going to reflect an increase in aggregate expenditures over what's actually being reflected in GDP. So if you spend enough money to produce another 100 refrigerators this month because you sold an extra 100, well, then you're going to have a difference between how much the economy is actually spending on production in the next phase and the value of the production that was made in the current period. And so in that case, aggregate expenditures will be higher than gross domestic product and will actually have an increase in GDP when that new spending cycles through, produces new fridges, and there's new fridges out in the economy. On the other hand, if there's an unplanned increase in inventories, that means we sold less than we anticipated. And if we sell less than we anticipated, so if you expect to sell 150 refrigerators a month and you only sell 75, well, now you have an extra 75 fridges in inventory that you either need to unload, or it just is going to limit the amount of fridges you need for the next month. And so if that's the case, then you're going to produce fewer fridges in the next month. So if you're only producing 75 to meet that consistent level of 300 a month before they're sold out and your inventory gets depleted, you're going to produce fewer fridges. And if you produce fewer fridges, you're going to spend less money in production, and that won't be reflected in GDP right away because GDP is used to you producing 150 and 150 and 150. And then so when you decide you're going to make 75 and spend the money for 75, GDP is going to say, oh, well, we're still making 150 because that's what was flooded into the market in terms of supply. But then in the next month, the next quarter, there's only going to be 75 units worth of production, and then GDP is going to reflect that with a lower number. So then GDP will fall, production will fall, and then basically this will continue for both cases until we end up reaching that point where aggregate expenditures and GDP are the same again, and then we're in a macroeconomic equilibrium. But if we get a decline in economic production consistently for at least 6 months, we consider that to be a recession. So a recession could occur either from the production side of things, or it can come from the demand side of things in terms of consumers changing their habits, which is something we'll talk about in a little bit. So this is what I'm going to call the Keynesian cross. So it is not some sort of religious symbol for economists. It is just basically called a cross because we have this 45-degree line that bisects the graph. So on the x-axis, we're going to have y, which is indicative of real GDP or just our national income, which is reflective of our production value. And then the y-axis is going to be aggregate expenditures, which is reflective of our spending in the economy. So whenever what we're going to have is we're going to have an aggregate expenditures line that's going to come out of the y-axis and basically be upward sloping and intersect this curve, or excuse me, this Keynesian cross, this 45-degree line at some point. That 45-degree line is always going to be indicative of what GDP is at any given point of aggregate expenditures, but the point in which they intersect is going to ultimately be the macroeconomic equilibrium point. Does that mean we're actually going to be there at any given point? Not necessarily. It just tells us where we'll eventually stabilize at. So here is a little simulation of what is actually going on. So as I mentioned before, the aggregate expenditures line is going to come out of the y-axis and be upward sloping like this. And we'll talk about all of that nuance in a little bit. Why is it upward sloping? Why is it not coming out at 0? What is going on with this weird graph? So anyways, what's going on here is this intersection point represents the point of macroeconomic equilibrium. But if we have an unplanned decrease in inventories, such as here, this indicates that aggregate expenditures is higher than GDP. So what happens is at this point in time, aggregate expenditures is right here, so we're spending, say, $8 trillion in change, but GDP is only at about $7.75 trillion, which means that in the next phase, when that production actually goes through the production process and gets completed, we're going to trend in this direction, and then we'll end up at our macroeconomic equilibrium point. So when we sell, so this is basically saying we sold more than we anticipated, and so as a result, GDP in the next period, once the production is actually finished and reflectable in GDP, we will have an increase in productivity up into that macroeconomic equilibrium point. On the other hand, if we're over here, then we actually have an unplanned increase in inventories, which means we sold less than anticipated. So if we sell less than we anticipated, we're going to produce less in the next phase, which is why AE is below the actual level of GDP and will reflect back to this same macroeconomic equilibrium point here at about $10 trillion. So why is this the case? Well, as we'll learn, aggregate expenditures is again a component of consumption, planned investment, government spending, and net exports. And this aggregate expenditures line is going to be indicative of a bunch of assumptions that are determining consumption and investment and government spending and net exports. As we will learn, all of these things, I'm going to put bars above them, are going to be considered exogenous. And that means that their values are determined by variables outside of the model. Consumption is partially exogenous and partially endogenous, which is why we're going to end up having this upward sloping shape of the AE line. So as I mentioned before, the Keynesian aggregate expenditures model, which is including consumption, planned investment, government spending, and net exports, is going to treat investment, government spending, and net exports as exogenous, meaning that they are not contingent upon GDP. So even though it seems like investment is contingent upon GDP, it's more so the other way around, that GDP is contingent upon investment. And so investment is basically going to be decided by the profitability that the firms can receive and how much they're selling. That's not based on GDP. Government spending is budgeted out by Congress, so that is, or the state assemblies, so that is not something that's determined by GDP. And net exports is a little weird because in a way it could kind of be based on GDP because income has a little bit to do with net exports, but because we're comparing when we're doing that, we're comparing variables that are outside of the model to determine whether or not our income has an impact on imports and exports. We're going to treat that as exogenous as well, because we don't have foreign income, we don't have exchange rates and stuff built into the model. Consumption also has an exogenous component, and that's known as autonomous consumption. Autonomous consumption is basically the amount of spending that consumers would undertake even if they didn't have any income. So this is to say that basically if real GDP was zero, people would still spend money. They still have rent bills due, they still have to eat, and they still have things that they have to take care of. So during the coronavirus pandemic, this is a pretty strong indicator of autonomous consumption. So unemployment rose substantially during this time, and so a lot of people were furloughed from the government. They were laid off from their jobs and factories, and only essential workers were able to work. And so as a result, a lot of people ended up not having income for a while. So the government did step in, and that's something that we can talk about during the policy unit, and provided the stimulus packages, or there's unemployment insurance that individuals can claim. But otherwise, those individuals, if they were waiting for the stimulus check, or they didn't have money coming in, they didn't cease to buy things. They didn't cease to stop eating. They didn't cease to stop paying bills. I mean, there were times in which forbearance was allowed, so that meant that, like, if you had a mortgage payment or student loans or things like that that were behind, you could wait a few months to pay them back. But otherwise, you would spend from savings, or you would put it on credit, but there's going to be some level of consumption that occurs even when you have no income. And so that's known as autonomous consumption. However, if GDP is reflective of national income and is a variable that is indicative of national income, then you're going to have a situation where consumption is contingent upon it. Because if you tend to spend more money when you have more income, which we all do, it's a positive relationship, then you're going to have a slope to that line. Because if it was all exogenous, it would just be a horizontal line, because it's all independent of GDP. But since it's partially dependent upon GDP as a result of consumption, we have that upward sloping shape of the aggregate expenditures line in that graph. So what determines our consumption levels? So our current disposable income is going to basically be the endogenous component of this. So this basically speaks to our endogenous component and results in our aggregate expenditures line to be upward sloping. But that's also indicative of why this doesn't come out at zero, because even if we ignored investment, ignored government spending, and ignored net exports, we would still have that autonomous consumption. So that's the reason why the graph is not coming out at zero. So that's our autonomous expenditures in general. So if it's just the AE line itself, that's also including investment, government spending, net exports. But if it is just consumption, then it's going to be our autonomous consumption. However, the rest of these are all exogenous, all determined outside of the model. This is determined inside of the model because of the fact that it is based on income. So endo means inside, exo means outside. So if you've heard of like an exoskeleton, means that like kind of the like skeletal form of an insect is on the outside of its body and not on the inside, like a vertebrate. So household wealth is just basically the accumulation of savings that you have. So that's not indicative of current income, it's indicative of past income and savings. But that is a potential asset that you can use to buy things with, particularly in times of economic struggle. You can lean on your savings or your emergency fund. If you want to make a big purchase, like buying a house or buying a car, you've wanted to save up for it, start a business. That's indicative of savings and wealth. Expected future income is also something that determines consumption levels. So we talked about expected future prices before with demand and supply. But expected future income determines how much you're going to spend, because if you know you're going to get a big bonus check, or if you know you're going to get a raise, then you might be more likely to spend money now. So the example I like to give is about LeBron James. So I grew up in Northeast Ohio, and LeBron is only a few years older than me, but when he was a senior in high school, his mom, for his 18th birthday, she was a single parent. I think she had one job, so she didn't have a lot of income. They were not very well off. LeBron Gloria James, LeBron's mother, purchased him an H2 Hummer for his birthday. It was gray. I think someone customized it and made it white, but it was originally gray. And so the Ohio High School Athletic Association was very upset about this. They thought it was going to violate amateurism rules, but Gloria supplied that it was a loan. It wasn't a gift. The car dealership didn't give it to him for free advertising. She took out a $50,000 loan for the Hummer, and it was a birthday gift to LeBron. Clearly, if I probably applied for that loan, I mean, these days, I probably would get approved for it, but like in the past, around 2003, they weren't giving out $50,000 car loans left and right like they are for like trucks these days. But anyways, why did he get approved, or she get approved for the loan? Well, the reason why was because LeBron had been on ESPN, on the cover of Sports Illustrated and ESPN the magazine and Sporting News, since he was 16 years old and a sophomore in high school. And so his games were being televised on ESPN even while he was still in high school. So it was already assumed that he was going to be the #1 overall pick in the NBA draft in June of that year. We didn't know where he was going to go. Luckily for us, he ended up staying in Northeast Ohio and playing for the Cavs. But they knew that he was going to sign a deal. He ended up signing, I think, a $100 million contract for 7 years the day he got drafted by Cleveland. So there was no worry about whether or not that loan was going to get paid back. So they were willing to authorize that. The funny story about it was after the Ohio High School Athletic Association decided, well, he can't be suspended because there is no rules that he broke. He drove around a model version of the car that he had just gotten from his mother, remote control, on the court during the halftime of the junior varsity game. And it just so happened that he was playing my high school that evening, and we had a 6'8" center that was going Division I, and he was pretty solid, and we thought we had a pretty good team. And I think he even was on ESPN too. And LeBron ended up putting up 50 points in 3 quarters, sat out the entire 4th quarter, and posterized our 6'8" center. So if that doesn't tell you how good LeBron was going to be, well, the proof is in the body of work that he's generated over the past 2 decades. Price levels. So again, if things are more expensive, we've talked about this before in terms of the income effect. If there's an increase in price levels, then it decreases your purchasing power. Now, what we mean by price levels is, again, we're talking about the macroeconomy now, so we can't just say the price of a specific good or service. We're taking the average prices of the market, and we are assessing those. And so if price levels go up, and consumption typically goes down, and if price levels go down, then consumption typically goes up. And interest rates are the same thing because it's the price of borrowing money. So if your interest rates are cheaper, it means it's cheaper to borrow money. And if interest rates are more expensive, it's more expensive to borrow money. So for the former, people are going to consume more, and for the latter, people are going to consume less. Now, this brings me to a very important thing to mention, and this is known as the marginal propensity to consume. So the marginal propensity to consume is basically a ratio that estimates how much additional consumption will exist when an individual gets an additional $1, $100, or $1,000 in income. And the reason why this is so important is because this determines the slope of the aggregate expenditures line. So why does that matter? Well, when we get to talking about what's known as the multiplier effect at the end of this lecture, the multiplier effect is directly related to the marginal propensity to consume. And so the way you determine the marginal propensity to consume is the change in consumption. So that triangle represents delta, which means change. So it is the change in consumption divided by the change in YD, which is disposable income. So it's income minus taxes. So Uncle Sam gets their share, and then whatever's left over, how much additional of that do you spend? And so that's the reason why it's upward sloping, and it basically derives the slope of the aggregate expenditures line in that Keynesian cross model. But it also has a complementary relationship with savings. So before we talked about how savings is equal to investment, and in order for you to be able to invest, you have to save. Well, that rings true. So in order for there to be any sort of drag in terms of how much money is spent, we have to actually save some of it. So let's say that you spend 70 cents on every additional dollar that you earn in income. Well, then that would mean that your marginal propensity to consume would be 0.7. And since the complementary relationship of MPC and MPS, which is the marginal propensity to save, is 1, meaning that like for every dollar you earn, some of it goes to consumption and some of it goes to savings. So that would mean the MPC would be 0.7 and the MPS would be 0.3. And those add up to 1. Now, it is entirely possible that you spend more than you earn. And if that's the case, then that would mean that your marginal propensity, so let's say that you spend $1.10 for every dollar that you earn, that would mean that your marginal propensity to consume would be 1.1, and your MPS, your marginal propensity to save, would be negative 0.1. So it still equals 1. It's not like it magically becomes worth more than 1 because you're spending more. It just makes your savings rate negative. The reason why it's negative is because if you're accruing debt in your consumption phase, then that means that you're going to have to save even more in the future to offset that debt. That's not even measurable in the amount of income that you currently have. So the MPC, again, is the slope of the aggregate expenditures line. So we discussed how it's upward sloping because of endogenous consumption, which is basically the increase in consumption as a result in an increase in income, and that the sum of it is 1, and between marginal propensity to consume and marginal propensity to save, because if you're not spending it, you're saving it in some way, shape, or form. And this will be very, very important when we talk about the multiplier effect. So as we can continue talking about the components that determine aggregate expenditures, so we talked about consumption. Now we can talk about planned investment. Again, investment, net exports, government spending, those are all exogenous, so they're all determined outside of income. So you won't see an income variable here for determining planned investment. But it is very important to know all these variables, because when it comes to policy and shifts in the aggregate supply and aggregate demand curve in the future of the course, it's important to know all these things because any of these things could cause those things to change. And so if you don't know them, even though the model is kind of in a way too simple because it's just ignoring or simplifying something that's very complicated. So like when we say like investment is causing aggregate demand to shift to the right later on, like it could be a number of things. It could be tax changes, it could be interest rate changes, it could be expectation changes. You don't necessarily know at any given point in time, which is why macroeconomic models are very complicated and cost a lot of money if you want one for your business. So please keep that in mind. Now, what determines planned investment? So again, expectations of future profitability. So if the firm believes that they're going to make more money in the future, they're probably going to be willing to invest more in their production process. Interest rates, if it's cheap, again, just like with consumption, if it's cheaper to borrow, then they're going to be more likely to borrow that money to invest because they think they'll get a higher return on their investment if their interest rate's lower. But if interest rates are higher and it's more expensive to borrow, then they're going to be less likely to borrow. They might cancel some projects. Taxes are important, so if the government decides to cut the corporate tax rate, that's the theory is that that will induce additional investment into research and development or expansion of their business. We saw during the 2017 tax cut by the Trump administration that unfortunately a lot of businesses did what were known as stock buybacks. So when time came for the coronavirus shutdowns of the economy, a lot of those businesses who should have had a lot of extra capital from the taxes were now struggling to have cash because they basically took all that extra money that could have been done for investment and just put it into corporate stock buybacks that really didn't create any money. It just created wealth for the investors and the stockholders and the shareholders. So again, that's one of the equitability and arguments about like who gets tax cuts and where does it benefit most because of these arguments of trickle down that didn't really work in the 80s and it didn't necessarily work in the teens. So, and then lastly, we have cash flow, which is just the difference between the cash revenues received by a firm and the cash spending by the firm. So basically, if you have positive cash flow, you've got extra money that is cycling through the economy, you can use that to, or not the economy, the firm, you can use that to expand your production process. But if you're negative cash flow, you're going to be limited in the amount of inventory that you can generate for sales, and so that's where a lot of small businesses run into trouble is they don't have a lot of cash flow, so they can't keep their inventory stocked, and that kind of in the way chokes off the potential of the business. Lastly, we will talk about what determines net exports. So you might have noticed that I skipped government spending, and the reason why I skipped government spending is because of the fact that government spending is a big old question mark. Congress or our state assemblies decide how the budget is allocated, so who on earth knows how they do that? You would think that they would use GDP and economic data, and hopefully to some extent they do, but generally speaking, a lot of it can be political. So, as a result, we don't really know what the determinants of government spending are other than discretionary fiscal policy during times of economic recession or expansion. But lastly, we'll talk about what determines net exports, and there are three variables here. The first one is prices comparatively between the rest of the world and the domestic country. So if the average prices of goods and services in a foreign country or the rest of the world are lower than they are in the United States or the domestic country, then we tend to import more. And foreign countries, if our goods are more expensive, we're going to export less because they're purchasing less. So if that's the case, then if we're exporting less and we're importing more, then that means that net exports are going to be negative, because if we're importing, so if imports go up, which is a bigger negative, and exports go down, then that means that the positive is smaller, the negative is bigger, which yields a net negative. Now, if prices are cheaper in the domestic country relative to the rest of the world, then the opposite will happen. Imports will go down. Exports will go up. The positive will get bigger. The negative will get smaller, and that will yield a positive in terms of net exports. Now let's say that the growth rate of GDP, so again, this one's kind of funky because of the fact that it in a way includes income, but because of the fact that it's a relativity calculation between the growth rate of income here versus the growth rate of income in foreign countries, it's still got to be considered exogenous because that other variable of the rest of the world's income and economic growth is not factored in our model. So if the United States grows at a rate faster than the rest of the world, then we'll have the negative side. If the growth rate of the rest of the world is faster than America, then we'll have this outcome. But if we have a situation where the growth rate in the United States is faster than the rest of the world, then we'll have the negative situation again, where imports get bigger, exports get smaller, this gets smaller, this gets bigger, and we get a net negative. And then the last one has to do with exchange rates between currencies. So this has to do with what's known as the value of the dollar. When I talked about GDP and net exports generally being negative in the United States, I said that basically during times of recession, typically the value of the dollar decreases, and that usually increases and improves our trade balance. We're still net negative in terms of net exports. We're net importers, but the relative amount or the magnitude we're importing diminishes and the amount we export increases. So if the value of the dollar decreases, then that means that the prices, so again, when we change the value of currency, so the value of the dollar relative to the yen, the yuan, the euro, the baht, every other currency in the world, if the value of the dollar is decreasing, then that means that the prices in which we are selling our goods for in the United States are going to be the same, which means that if someone can exchange euros for more dollars than they otherwise could in the past, and the prices aren't changing here, then they're more likely to come here and buy our stuff because their purchasing power is higher. So I have an uncle that lives in Canada, and for a while, the only time we saw him was when the Canadian dollar was strong relative to the United States dollar, because then he would come and buy a bunch of stuff in America and take it back home to Ontario. And so if that's the case, then we would reflect that with a increase in our exports, increase in the positive, decrease in the imports, decrease in the negative, which gives us a net positive in net exports. Now if the value of the dollar goes up, then we have the opposite. So bam, 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 and bam, and bam. So our imports would go up. Whoops, sorry about that. Our imports would go up. Our exports would go down. Our positive would get worse. Our negative would get worse. And we would have a net negative. So all of these factors are going to result in changes in our aggregate expenditures and by virtue eventually our aggregate demand. So it's important to keep in mind all of these relationships and ratios. So now let's graph macroeconomic equilibrium again, but let's do it component by component. So if we follow this animation, it basically added each component of aggregate expenditures at a time until we got all four. This is useful because this helps us summarize what we were talking about before. Investment, government spending, and net exports are all going to be exogenous, which is why the distance between the lines when we go beyond consumption are exactly the same. The slope that's occurring is only because consumption is also being factored in. So notice consumption is a part of every line because we started with consumption, then we added an investment, so it's consumption plus investment. But the distance between planned investment here and planned investment here is exactly the same, which implies that it has no bearing or impact as a result of income changing. So that implies that planned investment is exogenous. The same rings true here for government spending. That gap is the same all the way through. And then lastly, it rings true for net exports as well because it's the same width here and the same width here. So that gap being the same implies that net exports, investment, and government spending are all exogenous. So basically, the gap between here and here is the same as here and here. So it's exactly the same. It's constant. It's completely independent of GDP, which is indicated by the x-axis. With consumption, we see that it's not coming out at 0. So this right here is our autonomous consumption. So that goes back to the time where basically if you don't have any income, you still spend money. So spending in the economy will never really be 0 unless we don't exist. And then it's upward sloping. So if we have no income, we spend $2 trillion. And then for every additional dollar that we earn, we spend some fraction of it. And that fraction is the slope of this line, which is the marginal propensity to consume. So the slope of all of these is the exact same. They're all parallel. And that's because of the fact that the slope is the marginal propensity to consume. So it has everything to do with consumption, the additional consumption from additional income. The rest are unaffected by the increased income. So that's why we have an upward sloping aggregate expenditures curve. We don't start at 0, but if you took all of the exogenous factors and started here, because this is the actual AE line, it starts at $6 trillion. That is known as autonomous expenditures. Again, at different points, so like here, aggregate expenditures is higher than GDP at that corresponding point, so we would trend in this direction. Aggregate expenditures is lower than GDP at this point, so we would trend in this direction. So this point right here at $10 trillion is going to be our point of macroeconomic equilibrium. We'll stabilize there. But again, this aggregate expenditures is operating under the assumptions of everything that we talked about in terms of the determinants. So like when we talked about supply and demand in general, the demand curve is based on income, a certain level of income, a certain level of preferences, a certain expectation about prices in the future, a certain number of people in the market, and a certain relativity between the price of substitutes and complements, which in this case would be foreign goods. So all of those assumptions, so if the value of the dollar changes, this is going to shift. If prices change, this is going to shift. If interest rates change, this is going to shift. If our expectations change, this is going to shift. So all of that, anything tweaks a little bit, that aggregate expenditures line is going to shift up or down. And that's very important because if it shifts up or down, that's going to change the point of macroeconomic equilibrium. So let's say that we have an increase in expectations, that would shift AE up, and then we would end up at this point of macroeconomic equilibrium. Or we have a situation where AE shifts down, and then this would be our point of macroeconomic equilibrium in the blue right here. So any of those assumptions change, aggregate expenditure changes. Aggregate expenditure changes, the point it intersects with GDP is going to change. And so there's going to be different levels of macroeconomic equilibrium as a result. So let's talk about the multiplier effect. Let's say the government decides to spend more money. Let's say the government decides to build an infrastructure project that's worth $7 billion. It's going to increase GDP because, again, when we increase, it's an exogenous component, so it's going to increase aggregate expenditures exogenously, so that's going to result in an increase in GDP. But the question is it going to increase GDP by $7 billion? Is it going to increase GDP by less than $7 billion? Or is it going to increase GDP by more than $7 billion? That's the question. Well, let's do an example. Let's say that the government decides to increase investment spending by $300 million instead of $7 billion. Sorry, I got overzealous. And the marginal propensity to consume is 0.75. So again, this is important. I brought up the marginal propensity to consume. The reason why that's so important is because when spending occurs, it creates income, it cycles through the economy, and the rate at which we spend it when we get it as income is going to be 75 cents of every dollar. So how much will GDP increase by? Well, the reality is that if our marginal propensity to save was 1, so our MPC was 0, then it would be a 1-to-1 relationship. If the MPC was 0, then that would mean that the government sends $300 million, we have $300 million in our pocket, we sit on it, so there's no extra production as a result, because it's just that one-time spending of $300 million, we sit on the money, it doesn't do anything else for the economy besides that initial spending. But if we spend more than 0, then that means that on top of that initial $300 million that we're going to receive, we're going to spend a certain amount of that again, and then again, and then again, until all $300 million eventually are saved somewhere under mattresses, in Bitcoin, in banks, wherever it ends up. So in order for us to determine the actual amount, there's going to be a multiple. It's going to be greater than 1, unless our MPC is 0. Because then if our MPC is 0, then 1 divided by 1 is 1, and that would be 1. So it would just be 300 million times 1. So the way we calculate the multiplier is we take 1 divided by 1 minus the marginal propensity to consume, which is the same as 1 over the marginal propensity to save, because there's that complementary relationship between marginal propensity to consume and marginal propensity to save. So in this example, since the MPC is 0.75, we would do 1 over 1 minus 0.75 or 1 over 0.25, whichever you want to do. Both going to give you the same answer, and the answer is 4. But that's the multiplier. That's not the answer to the question. It was saying how much does GDP increase by? So it's going to increase by a multiple of 4. So if we take the initial amount of spending by the government of $300 million and multiply that times 4, then that tells us the actual contribution to GDP as a result is going to be $1.2 billion, or $1,200 million. So if we did the same thing for the $7 billion investment that I was talking about earlier, then, and if the MPC is, say, MPC is 0.9, well then 1 over 1 minus 0.9 is equal to 1 over 0.1, which is 10. So if we do 10 times 7 billion, that infrastructure project would be equal to $70 billion in GDP growth, because originally the $7 billion project is going to hire construction workers, general contractors, suppliers, and then those people are going to be compensated. They're going to take that money and they're going to spend 90% of it. So if you have a $7 billion project and you spend 90% of it, well, then that is $6.3 billion in addition to the $7 billion. So you're already at 13.3. And then you spend 90% of that 6.3 once it cycles through, and then 90% of that, and then 90% of that, and 90% of that, until every single dime of that $7 billion is saved. And at the end of the day, you could build a program that does it. You could do whatever you want, but you can calculate and prove that the answer would be $70 billion. So again, why is this multiplier there? Just kind of explains to you that, again, if there's a $10,000 increase in spending, not saving, and the MPC is 0.75, that means that the person is going to get $10,000 in income. They're going to spend $7,500 of it. They're going to save $2,500 of it. And then the next person who got the $7,500 check is going to spend 75% of that. And then the next person who gets that remaining 75% of 7,500 is going to spend 75% of that. And it's going to keep going and going and going until the amount is 0. Since we have discrete money, meaning that our money's not infinitesimal, it's divisible by 100 pennies, so it's 1/100th of a dollar, then basically eventually you'll get to the point where the remaining income is a penny, and then they just round it off, so you wouldn't have any more money circulating from that initial spending. We will learn later on when we talk about fiscal policy of something that's known as the crowding out effect, which will mitigate some of that multiplier effect, unfortunately. And also, if you like increase taxes or cut spending, the multiplier works in the opposite direction, which is kind of sucky. But generally speaking, that's how the multiplier works. So why are we talking about all this? Why did we derive this model? What is the means to the end? Well, the end is deriving aggregate demand. So we talked about demand and supply a lot, all of the components that determine it, and how the intersections determine an equilibrium, and that's our allocatively efficient solution, and all that great stuff. Now what we're going to do is demand and supply is going to be a lot similar to what we talked about at the beginning of the semester, which is going to be really useful. But it's also going to be slightly different in the fact that it's including everything in the economy. So instead of it being the market for televisions or the market for bananas or the market for whatever, it's just going to be everything. So instead of it being price and quantity, it's going to be price and quantity, but instead of it being the price in specific dollar units or currency units for a specific good or service, it's going to be the average prices in the entire economy. So we talked about calculating consumer price index, calculating other price indices like the GDP deflator and stuff like that. Those are basically going to be our price variable. And then our quantity variable is going to be, instead of it just being a number of units, we can't really do units anymore because there's a bunch of different products. So our solution for that is GDP. So the reason why the definition of GDP is the total value of all final goods and services produced in an economy over a period of time is because of the fact that the total value thing allows for an accounting that's simplified, and we can actually graph that now. So why do we need to build this other model to create another model? Well, before we had a demand schedule, and it was a table that had prices and corresponding quantities demanded. It's really easy for one product to be like, well, if I sell it for $5, how many people want it? But when you have a million different products and a million different services mishmashed together into one model, into one variable, you don't know what the answer is. So what we do is we find those little points of macroeconomic equilibrium that correspond with the relationship between aggregate expenditures and GDP given a certain set of conditions. And those operate under a certain price level assumption. So again, remember prices, taxes, interest rates, expectations, all of that is baked into that aggregate expenditure model and graph and shape. Well, that also means that that's assuming that there's a specific price. So if we change the price, we shift the aggregate expenditure line, and then we're going to change the point of macroeconomic equilibrium. And when we do that, we have corresponding prices, corresponding levels of GDP, and then we can basically do what we did with the good old-fashioned demand schedule at the beginning of the semester. And we can just plot that, graph that, and then we have a demand curve. This graph shows us basically how shifts in aggregate expenditures can change based on variables that fluctuate as a result of changes in the variables that we talked about. Now, the one that we're going to be most focused on here, we're actually going to be interested in all of them, but the one we're going to be most focused on here is our price level. Because when we derive supply and demand, we have a demand curve and we have a supply curve, and the axes that go with that are usually price and quantity. So we want to focus on price level because that's really going to be our measurement of price. So baked into these two aggregate expenditures line, AE1 and AE2, are going to be specific price levels. So if the price level goes up, like on the left-hand graph, then our aggregate expenditures curve shifts down, and we go from this macroeconomic equilibrium point to this macroeconomic equilibrium point, which is going to basically indicate different levels of GDP for different price levels, which is what we want. Likewise, if price level goes down, it's going to shift up aggregate expenditures, and we're going to go from this one to this one. So for this one, we went from 10 trillion to 9.8 trillion, corresponding to different price levels. And then this one, we went from 10 trillion to 10.2 trillion, corresponding to different price levels. So what we can do with that is we can take that price level, take that level of GDP, plot them like we did with a demand schedule in the past, and then we can connect the dots, and then boom, we've got our aggregate demand curve. So let me do a little drawing for you. So here is our 45-degree line Keynesian cross, the point where Y and AE are the same. So we have Y down here, and we have AE up here. So we have an aggregate expenditures curve like so, and at this corresponding point we have a level of GDP and AE are the same. This level of aggregate expenditures, we'll call it AE1, corresponds to a specific price level. Let's say the price level is 210. But let's say that prices decrease in the economy. Well, if prices are lower, people tend to consume more, so that's going to shift our aggregate expenditures line up to here. So let's say this corresponds to a price level of 207, like that. We have Y2. Let's say that the price level goes up, well, to like 215. Well, that's going to shift AE down to here. So we have aggregate expenditures 3 corresponding to price level 215. We have a lower GDP right here. So we have Y3 corresponding to price level 215. We have Y2 corresponding with price level 207. And we have Y1 corresponding with GDP 210. So assuming that this is actually a number here for Y3, Y2, and Y1, we now have an aggregate demand schedule just like we had a demand schedule before. And what we did is we took all the points and we plotted them, and we're going to put price here and we're going to put GDP here, just like price and quantity. And then this is Y3, this is Y1, and this is Y2, and this is 207, this is 210, and this is 215. You connect the dots, and congratulations, you now have an aggregate demand curve. So this is a little bit easier to read than my drawing. But basically operating under those assumptions of the aggregate expenditures curve shifting as a result of fluctuating price levels, you have a price level, and then you have a macroeconomic equilibrium GDP that corresponded with that price level in the aggregate expenditures model. You plot those points on this graph here, price level on the y-axis, GDP on the x-axis, and then you connect the dots, and then congratulations, you now have the aggregate demand curve. And so in the next lecture, what we're going to do is we're going to talk about all of the assumptions of the aggregate demand model, just like we did with regular demand and just like we did with aggregate expenditures. It's really important because all of the aggregate expenditure stuff that we talked about is baked into aggregate demand because it's what we use to make it and derive it. So all of that is very useful information. But we will also talk about all of the things that will cause aggregate demand to shift, such as expectations, fluctuations, and most importantly, monetary and fiscal policy. So that'll be a little bit of an introduction to that. We'll talk about it in more detail later on. We'll also talk about aggregate supply and how there's actually going to be two supply curves, because the difference with equilibrium here, unlike with the regular supply and demand model, is it tells us where we're at, but we want to know where we're at relative to where we should be, because the macroeconomy could be falling short, could have high unemployment, could have high inflation, we could be producing too much, too little, and that would allow for us to facilitate policy in accordance to what we need at that point in time. So we'll have a vertical supply curve that corresponds to aggregate supply in the long run. We'll have an upward sloping supply curve like you're used to that represents the short run aggregate supply. This will also help us visualize the differences that we've talked about in regards to inflation and unemployment and other types of things in our class between the classical model and the Keynesian model. And then we will continue after that lecture talking about money, what its role is, how it works, how we measure it, what the Federal Reserve and what central banking does, what monetary policy is. Then we'll talk about what fiscal policy is. And then that'll pretty much take us to close to the end of the course. So if you have any questions, please feel free to reach out. Otherwise, I wish you the best of luck on your assessments in this class and any other that you might have, and we'll talk soon.